Back in November, we highlighted Canadian Copper, who at the time we described as being an exception to the rule when it comes to big promises, because those promises were being kept. A handful of months later, and well, the company has continued to execute, with a snazzy new preliminary economic assessment now having been released for their flagship assets in New Brunswick. And we're taking a break from catching up on Q1 earnings to take a closer look. Let's dive in. The preliminary economic assessment at hand here is for what Canadian Copper refers to as the combined strategy of bringing together their Murray Brook deposit with the existing and permitted Caribou processing complex, which is found just 13 kilometers away to the east. The premise is quite simple. The plan is to mine the polymetallic Murray Brook deposit using open pit mining methods and haul the ore 13 kilometers down the road via a dedicated haul road to the recently operational Caribou complex, which Canadian Copper is in the process of acquiring. With the mill already established, initial costs here are simply incomparable to many peers in the space, which allows for a robust internal rate of return and a short payback period, which isn't all that common in copper projects, which are known for big upfront spending alongside drawn-out payback periods. So what do those economics look like? All right, so the PEA here is based on an operating mine life of 13.2 years, which would see the Murray Brook deposit produce on average 30 million pounds of copper equivalent, or alternatively 98 million pounds of zinc equivalent every year. On a broken out basis, that translates to average annual production of 8 million pounds of copper, 48 million pounds of zinc, 10 million pounds of lead, and 739,000 ounces of silver. The mining operation here is to consist of a conventional drill, blast, load, haul open pit mine, with production expected to average 3,300 tons per day. The open pit mine will have 4 development phases, with a total of 15.4 million tons of mineralized material being pulled out of the ground. Over at the processing complex, the current 3,000 ton per day operation will see some debottlenecking occur at the ball mill, leading to capacity growing to 3,300 tons per day to match the mining capacity. Some other modifications are also planned, including the conversion of a ball mill formerly used for a zinc regrind to that of a secondary primary ball mill, which will translate in parallel to the existing ball mill. 3 concentrates are expected to be produced here, including a copper, lead, and zinc concentrate. That concentrate will then be shipped 83 kilometers up the road to a deep water port at Belledune, where it will be loaded on ships for smelters based in European and Asian markets, thereby avoiding any potential tariffs down south. Further to that, quotes have already been received from vendors that previously processed concentrate from the Caribou complex, again putting Canadian Copper one step ahead. And as the icing on top, it's not believed that a federal impact assessment will be required because the 2 primary triggers for such assessments won't be met, meaning permitting and licensing should in theory be much easier and quicker. By now, you're probably waiting for us to get into the financial details, so let's dig in there next. The project overall is said to have a net present value of $172 million, an IRR of 36%, and a payback period of 2 years, which is on an after-tax basis while using a 7% discount rate. The economics here are based on $4.25 per pound copper, $1.30 a pound zinc, $1.10 a pound lead, and $27 an ounce silver. The combined strategy overall is expected to have initial capital costs of just $64 million, leading to a post-tax NPV initial capex ratio of 2.7 times. The bulk of that initial capital, $29 million, is related to initial mining, followed by contingency expenses of $8 million, process plant expenses of $7 million, indirect expenses of $6 million, and a further $6 million that will be spent to acquire the Caribou mill from the New Brunswick government, as per an outstanding arrangement already in place. Sustaining capital over the life of mine is forecasted at $49 million. And those 30 million pounds of copper equivalent that will be produced every year are expected to be produced at C1 cash costs of $2.95 US per pound of copper equivalent, and all-in sustaining costs of $3.14 US per pound of copper equivalent on a co-product basis. That in turn leads to average annual revenue of $168 million, EBITDA of $47 million, and free cash flow of $25 million. Over the life of mine, total revenue is estimated at $2.2 billion, while $626 million in EBITDA is expected to be generated. And all that, of course, is assuming a roughly 13-year mine life. But Canadian Copper suspects plenty of opportunity exists to extend that mine life following some more exploration on site. All right, so let's wrap it up. Where do we go from here? Well, we're told that environmental baseline studies are to be completed this year, while environmental registrations are expected to be completed by the first quarter of 2026, with permits currently expected to be in hand by the end of next year. Some drilling also needs to be conducted to determine the final open pit limit and to confirm recovery performance over at the processing plant. From there, it's a matter of obtaining construction financing, which at this stage is expected to be non-dilutive, and then getting shovels into the ground, which quite frankly is an outstanding timeline to production for a company that as of the end of 2024 had raised total capital of less than $5 million. It doesn't get more disciplined than that, folks. Oh, and did we mention that the NPV here is less than 0.1 times the current market cap of the company? I gotta say, I'm long and I like the story. All right, everybody. If you have any thoughts on Canadian copper, let me know in the comments section. Or if there's other stories you want us to cover, let us know. We read every comment, we take notes, and I can promise you guys, we are here to deliver for you. All right, everybody. Thanks for watching. If you can do me a big favor, smash that like button, subscribe, ring that notification bell. All right, everybody. I'm out.